Tom Lee shared this post from David Rosenberg, founder of Rosenberg Research. And yeah, it's not great. David Rosenberg says the June ISMs undercut consensus views, and the combined levels are where they were in 2001 in Q1, 2008 in Q1, and 2020 in Q2. But hey, the consensus says there's no recession coming, so I guess it won't come, right? Wrong. The chart below says it all. If the internet couldn't prevent a 2001 recession, why would AI stand in the way of Mother Nature in 2024? So David Rosenberg definitely thinks a recession is coming, and we got to be honest with ourselves. The data that we got yesterday with ISM services was very recessionary. If you exclude the 2020 crash that we seen, because a lot of that was artificial, it was because everything got shut down, right? Not really a typical recession. You are still at the same levels that you were at mid-recession in 2008. And normally when the ISM services composite PMI goes under 50, you are already in a recession historically. Services typically do not contract in this country. And services had a surprise contraction just yesterday for the month of June. But yet markets found a way to go higher yesterday, up 0.5% for the S&P 500. Tom Lee shared this post from David Rosenberg and says data definitely was soft this week. And let me tell you, we have more data coming out tomorrow morning that will be massively important for markets. It could actually give you the first down 2% day in like 500 days. You haven't seen the S&P fall 2% in a single day. You definitely need to hear this. There is the possibility that markets just continue to go higher, but what tends to happen is, yes, the first 2 weeks in July are the best period of the year for any year, but not because you have a lot of big green days, but because you have a lot of small green days, not a lot of red days. Specifically, the first 3 days heading into July 4th tends to be very positive. As people are excited for the holiday, there's lower trading volumes, people are going about their daily lives, right? It's summertime, people are enjoying themselves. Congratulations, if you're watching this video, you're gonna go far in your financial life because, hey, there's better things probably to do. But what you actually see happen is about 75% of the time, the 3 days after July 4th tends to be red. So from that standpoint, Friday, tomorrow, Monday, Tuesday of next week could be a little negative. Now, Tom Lee does share this post from his colleague over at Fundstrat talking about Bitcoin potentially hitting over $100,000 this year. It is worth mentioning that Bitcoin over the past 24 hours or so has really started to sell down from about $61,000 down to a low of about $56,000. About a $5,000 drop, 10% drop or so from that point to the lows in Bitcoin in a pretty short amount of time. That's kind of a risk off leading indicator heading into tomorrow. Futures are currently down for the NASDAQ about 0.15%. S&P futures are negative 0.03%, and the Dow is up 0.1%, but it's really gonna come down to the data tomorrow morning, and we'll talk about that in just a moment. But first, this is what Fundstrat says about Bitcoin reaching $100,000 this year.
I think what could happen is if we get the dollar rolling over, if we get the macro tailwinds that we expect to get, in addition to outflows that surprise to the downside, I think that could kickstart some speculation across, all liquidity sensitive assets, particularly ETH, because if people see that, ETH outflows are a lot more muted than they were expecting, ETHE outflows, that is, I think people are going to be inclined to speculate more. That'll increase the basis, bring some flows in to arb that basis, and that in and of itself can beget additional flows. And I think that's kind of how you can get to that 5 billion of inflows in the first 5 months rather easily.
And let me just tell you right now, if Bitcoin goes from its current price of about $58,000 up to anywhere close to $100,000 by the end of this year, you're going to be in a very risk-on kind of market environment. And I think at that point, you're going to be seeing small caps playing along. Tom Lee still believes small caps can rally about 50% this year. I would imagine he's extending that out to next year as well. But I think you would see some broad market participation if he is correct over at Fundstrat. Now, Tom Lee also shared this video on his X account from Jeff DeGraff over at Renaissance Macro Research, really just telling people he agrees with what Jeff has to say.
Jeff, it's great to have you back on. What are you watching right now? Let's start with chart number one.
Well, chart number one is a little more short term, but we just kind of pulled this one out, thinking of things to do for the summer, and we were shocked when we broke the months of the year down by first half, second half. It revealed pretty starkly that the first half of July is actually the strongest period of the year, followed by December, the last half of December. So I was pretty shocked by that. I knew it was firm, but to see it actually overtake the last 2 weeks of December is pretty telling. So we're in a pretty good spot here short term. We tend to get decent seasonality into earnings season, and then it starts to waffle a little bit on us. So, from a very short-term perspective, I think things are in good shape. We'll probably have some seasonal tendencies and some softness in August, September, and then kick things back in at the last half of the year.
Okay. And then one of the other things you're watching very closely is credit spreads. We know they've performed very strongly, perhaps surprisingly so, given some of the mixed macro data we've talked about and what you would expect to see in a high interest rate environment. What are the charts showing you here?
Yeah, no, you're exactly right. It's one of those things where, had you told me 3 years ago where the Fed would be today, I'd say credit spreads are going to be 300 basis points, and they're not, and they continue to look good. And this is just one example. We look at a lot of different ways to try to skin this cat, and they're all saying the same thing, which is there is ample amount of liquidity in the system for the economy and so far for the markets. And it's stabilized, but it's stabilized at a low level. It hasn't turned higher. And I think that's good news. And this is one of the things that the bears really missed over the last 18 months, was just how well credit was performing. And they kept these bearish arguments going. And the credit spreads were giving an awful lot of information. And I think they continue to give us bullish information today. We'll see where this stands in September, October. But that'll be one of the things that we watch for the back half to judge the duration of this rally and how long this bull market has to go.
Now, what about the NASDAQ 100? You think Bitcoin is the canary in the coal mine for it?
So, yeah, this is a little more complex, but we look for symptoms of liquidity, right? And those credit spreads are one example of that, and they tend to align themselves pretty well with the economy. But Bitcoin is what we call concept capital, right? There's no real use for it. It's, there's a lot of philosophical arguments around it, but it takes, ample liquidity to drive those things. And what we haven't seen out of Bitcoin over the last, roughly month or so is a new high. It's been consolidating. It's just moved back to the 200-day moving average, so it's still in trend. But if it breaks down, there is a relationship between the performance of Bitcoin and that of the more speculative assets in the market, and we label that the NDX as an example. And so a breakdown in Bitcoin is certainly something that would be unwelcome from our perspective in terms of what the implications are for the NDX going forward. So I think it's important. 55,000 is a big important number for Bitcoin. 72,000 would be a breakout and confirm the uptrend, which would be welcome news for the bulls and the back half of 2024.
So as Jeff was saying there, if you look at crypto, specifically Bitcoin, and the 200-day moving average, that is currently at $58,447. Bitcoin is at $58,201. So you really want to watch this. You're only about $200 below your 200-day moving average right now. But as he says, it would be a negative sign for the NASDAQ if you did get a break lower, especially lower from here back to the 56, 55,000 level. The NDX is the NASDAQ. So you want to watch crypto here. Now, take a listen to this clip that's titled "Maintain Market Exposure with Downside Protection," says Innovator ETF Tim Urbanowski.
Let's begin with our market panel as we set fresh record closes for both the S&P 500 and the NASDAQ. Joining us now, Barbara Duran of BD8 Capital Partners and Tim Urbanowitz of Innovation ETFs. It's great to have you both here. Barb, I'm going to start with you. I mean, it almost seems like, I realize lower volumes today, holiday shortened session, not necessarily a lot to propel the market in a bigger way, perhaps until Friday when we get jobs report. But nonetheless, it seems like the momentum in general lately has been higher.
Yeah, well, I think that's because you're seeing that investors are even more convinced, and particularly after Powell spoke yesterday, that the economy is strong but weakening. And you saw that in the ADP numbers this morning and continuing jobless claims up more than expected, probably the fourth time in a row in 4 weeks that it's been above 1.8 million. So we're softening, and we know the Fed is concerned about not going too far because it is a restrictive policy. So, but I think we also think that the Fed is going to cut, and yesterday indicated they're just waiting for a bit more confidence. And before the September meeting, we've got 6 inflation data points to go through in July and August, the PPI 2 times, CPI 2 times, the PCE. So you've got declining inflation, strong growth, and the unemployment number on Friday will be important. So I think the market is just taking a rest. Earnings start in earnest next week, next Friday with the banks, JP Morgan, Bank of America, which are making new highs. So I think we're just taking a little bit of a breather. I think a lot of it is holiday induced, and we're constructive on the market here. I think there's more to come.
Okay. Tim, how do you see this market, especially with the fact that we do have July seasonality factoring in here? First half of the month tends to be very strong in general each year. You have those somewhat dovish comments from Powell on disinflation traction. You have a mixed macro narrative, but certainly no signs that the floor is falling out of this economy, at least not right now. And then, of course, big tech strength continues to power the day.
Well, Morgan, I think this disinflation narrative that we've seen carry in the market really since October 2022 has a little bit of gas left in the tank. And that is what investors are going to be laser focused on for the next couple of months. So we expect equities to tick higher. But I think what's more important to be thinking about right now, Morgan, is really what does the future look like beyond that? And when that music stops, when investors start thinking about the election risk that is in play, or when bad news actually becomes bad news. And as you know, we have been adamant, and one of our top strategies has been maintaining market exposure with downside protection in place. We think that is critical right now. And just to highlight how advisors and investors are really thinking about this and how important it is, if you look earlier this week on Monday, we expanded our suite of 100% buffer ETFs, including options like a 6-month JAJL, where you have 100% buffer against losses, 5% upside on U.S. equities. Outside of the Bitcoin ETF launches that we've seen this year, that was the most popular launch that we've seen thus far in 2024 in the ETF market, which I think really highlights how important risk management is to investors right now.
And last but not least, take a listen to this clip from Jim Lebenthal that has been very bullish on markets for a long time, especially the AI trade, that says he believes a rate cut is coming in September, but he's nervous about the economy.
What some would suggest is a more inflationary agenda. What also they would suggest in the same breath is a more growth stimulating agenda too. So if you're looking at the potential of a strong economy, you're going to get rates potentially moving up in tandem with the idea that it's inflationary too.
There will be stronger pockets. Look, every sector doesn't trade in one direction usually. Maybe on a day like today it does, but over any period of time it doesn't. So what will be impacted is that we're seeing interest rates, again to Joe's point, finally impact the consumer, finally impact auto sales, impacting home sales. So there's a large segment of the economy that higher rates is going to continue to hurt, not help.
Well, that's even the gentleman sitting to your left, Weiss, has expressed his concerns of late about the state of the economy currently. You get it backed up, his concerns backed up by the data. Services, as I said, sub 50, right? Service has been the strong point. It's been the manufacturing squirrely numbers we've been getting for the better part of a couple of years. New orders weaker, as I said.
Yeah.
I mean, look, I've been optimistic for quite some time. However, it is hard to maintain the optimism in light of the data that's coming in, like the ISM services. I mean, weekly jobless claims, yes, they've popped up. They're not at a critical level yet, but they certainly have moved higher. I want to be clear to everybody who's watching. I'm not selling stocks. I'm fully invested and I am positioned for the broadening. But what I need to be clear about is that thesis relies on rate cuts starting in September at 25 basis points and alternating 25 basis points thereafter. I know, excuse me, at every other meeting thereafter. I think the Fed, the danger here, and it is significant, is they think that since they've gotten away with this for so long, that the economy has grown, the labor market has maintained strength for so long with a very restrictive, I mean, the Fed funds rate, 5.5%, the PCE is 2.5%. That's 300 basis points. That's restrictive, okay? Right. They're not going to get away with it forever. And, right now it looks like good odds, like September is going to be the first rate cut.
Yeah.
If that hangs in there, and if they do every other meeting from there, I think we can skate by. But I'm getting nervous, man.
And really, I think that's the case for a lot of guys on Wall Street right now, including myself. There is a potential bull path ahead that includes a broadening out of the markets, but I'm getting nervous here as well because it is a very slippery slope between the Fed cutting rates at the right time and having the confidence to cut rates and the economy holding up. The data that we got with the services PMI is a big slap in the face. It should be for the Fed, should be for everyone in the markets. And I'm actually surprised stocks went up on Wednesday. That's why tomorrow's data will be so critically important. If tomorrow's data signals things are getting worse, then I think you gotta be prepared for a market pullback here. Now, I do want to be very transparent with you guys. I do think there's two possible pullbacks in our markets. There is one pullback that I think is a little bit more likely. That could be a pullback of big tech. That could be a pullback of some of the stocks that have done really well. Your highest market cap weighted names, Magnificent 7 stocks may pull back a little bit. And you could see a rotation into value, into other defensive areas that are seen as maybe have bottomed out, right? Maybe that's industrials, consumer staples, stocks like that. Small caps, even for that matter. Just really a rotation that could cause a pullback in markets. Or if the economy continues to weaken from here, you could see a full-blown crash by the time the Fed starts to cut rates. Even look at the ECB or the Bank of Canada. They've already started to cut rates because they do not want that recessionary outcome. And it looks like our Fed, as Jim Lebenthal said, has been so used to things being good for so long now, I think they're a little too overconfident that things will stay good. And that does lead you to the question, is the Fed about to make a policy error? And coming tomorrow, we will have a lot more clarity on that with the non-farm payrolls. Over here on Trading Economics, the consensus is 190,000. Over on CNBC, the Dow Jones Industrial Average, the Dow estimate is for 200,000 jobs will be added. Last month, you had 272,000 jobs that were added. We'll see what the revision looks like. I'm sure we get a downward revision for last month, and we'll see if that number comes in high again. But it's not really about the job number itself. It's more about the unemployment rate. So the unemployment rate has went from 3.4% to 4%. Anytime you get that 0.6% rise is when in past cycles, 08, dot-com bubble, the 80s, the 90s recessions, when you get that rise of 0.6%, you start to get an exponentially faster rise in the unemployment rate following that. So it's possible the unemployment rate could come in at 4.2 or 4.3% tomorrow, surprise investors, and that could give you a sharp pullback, because at that point, with the unemployment rate rising like that, it's going to be hard to justify earnings expectations for the S&P for 2025 that are positive 14-15% for next year. Now, the best case scenario is the unemployment rate actually falls to like 3.9% or stays at 4%. It's bad if you go up at all here. If you go up to 4.1%, that's bad. 4.2, 4.3%, that's really, really bad and could give you a terrible day tomorrow in markets. If you actually fall to 3.9%, I think that would be a sigh of relief for investors that have been watching the jobs market really getting worse over the last couple of months. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.